Gurmeet Chadha too joins in on the show right now. Gurmeet, hi, afternoon. What's making the market nervous? Because it seems like we're the only market which is down amidst the entire world.
Hi, Asha. I think it probably it's difficult to do, but looks like it's by the price action. It's more to do with market sensing some escalation at the border between India and Pakistan, and that's the reason India probably is the only exception today on Friday, despite global markets doing better. Also, we've almost had a vertical 2,000 points kind of a nifty rally, so it's just that, and you have a long weekend ahead. So maybe some people want to probably take some risk off the table. But that's fine. I mean, considering the pullback we've had, some kind of consolidation, considering what is happening around the border, could be a small bit of a risk off trade.
Off it seems, but can't help talk about what's happening in the market right now, wherein you are seeing pretty much all sectors under pressure and a lot of steep and stark earnings reactions, if you will. Look at an SBI Life, for instance. That stock, even though it's come off from the top of the day, but it's still holding on to a gain of about 5%. Emphasis is a big mover. Persistent has been holding for a second consecutive session. Gurmeet, it really is seeming that the market A has been very quick in handing out the report card up or down for the entire IT pack, and somewhere you are getting the signs that maybe at least stock wise the sector could be at least close to bottoming out. What are your thoughts?
Aisha, I think this is how market should be. I think reaction on earnings, good earnings, you are rewarded. Poor earnings, you are punished. This is what you would want in the medium term and long term to play out. So if you see, for example, in IT, poor earnings, wherever the earnings were soft, IT stocks reacted negatively, whether it was Infi or TCS, and we saw HCL actually, doing relatively better. Similarly, for persistent, the markets have been pretty more kind there. Similarly for banks, ICICI, HDFC, and some banks actually reported good set, and you saw a slightly average or I would say softer number from Axis today, and hence action. So my sense is this is how it's going to be, because in an environment where growth is slightly subdued, global growth will come off, and we are looking at high single digit or maybe early double digit, and earnings on a best case. You are trading at 18, 19 times forward. So there is not much margin for error, despite the price correction we have seen from top. So I think the best hedge in this environment is earnings, and don't look at it only from a sector perspective. I think wherever within sectors we have seen diversion, good earnings being rewarded and bad being punished.
Right. So that's the take coming in when you talk about the earnings performance and how the stocks in the sectors are getting impacted on back of that. But let's take a look at some of these other counters also that are in focus in trade today. You have Emphasis also that is reacting to the numbers. Strong deal pipeline. The Q4 revenue also saw good growth. On the other hand, you have Laurus Labs that has declined in trade. The analysts have flagged off weakness despite the Q4 earnings being upbeat for this one. Cyient also has fallen after its numbers. Reliance has actually eased off a tad bit just ahead of its numbers. Jatin, let me get your view actually on Reliance Industries. How is this one looking on the charts to you? And do you think that this one will be able to lead the markets higher going ahead? Because everyone's waiting for that one outperformance from Reliance Industries.
See, on Reliance Industries, we believe that the stock has witnessed a decent run up from the lows of around 1120 to 1320. So the major part of the up move has already happened. So post this earnings, I think there could be a dip towards 1260 on the downside, and thereafter we might resume the next leg of the up move. So I'm expecting one leg on the downside towards the support zone of 1250, 1260, and thereafter we can expect a resumption of the up move. So post results, we might just see a dip towards 1250 odd levels.
Axis Bank, and in case you're wondering why the stock is weak after its numbers, even though you haven't seen any sharp reaction from the brokerages in terms of their target price revision, here's Gaurav telling us what's actually wrong with those numbers. Gaurav?
Well, yes, let's talk about Axis Bank's numbers. And when we look at the numbers, they fairly look in line. In fact, when we talk about profitability, that was actually higher than what the street is expecting because there was a one-off impact of around 800 crore rupees of reversal in provisions. But let's understand why the stock is not reacting positively. In fact, when we look at the stock performance, it is down more than 3%. So we have got a few points here. First, let's talk about the overall performance. If we compare Axis Bank's returns with all the peers that they have reported, in fact, in the likes of HDFC Bank and ICICI Bank, we've already seen that these banks actually reported numbers which were actually higher than what the street was expecting. But if we compare these numbers with Axis Bank, bank came up with inline set of numbers. When we talk about FY26 outlook also, these banks actually gave a very positive outlook. When we talk about Axis Bank, we got a positive outlook, but street is still unclear if the loan book growth is going to be higher than the industry average growth. And when we talk about deposit growth, although it was very strong, let's also understand and focus on the second point here is the loan book growth, because in this fourth quarter we have already seen that the loan book growth was as low as 7.5%, which was actually lower than the industry average growth that we have seen. And at the same time, there is ambiguity if this loan book growth will remain or increase in FY26. Although management has clearly stated that in FY26 growth and profitability both will be in focus and both will increase, but there is still a little ambiguity. Lastly, let's also focus on the credit cost part, because now management has said that in FY26 credit cost is likely to stay a little higher than the normal level because of the asset classification tightening that they are doing. So there is another point of concern about asset quality and credit cost, which is actually causing some pressure in Axis Bank. But all in all, a very inline set number is what we saw in Q4. Brokerages are also a little bullish on the stock, but as of now we are seeing a negative reaction in the stock price.
Right. Thank you so much for that, Gaurav, for outlining exactly why Axis Bank is reacting the way it is in today's trading session. 4%, almost 4% on an intraday basis is the downtick that actually Axis Bank logged in. Let's take a look at what Bank of Maharashtra is doing at this point in time, because that one also came out with the numbers a short while ago. You also had the likes of Hindustan Zinc, Motilal Oswal. These are some of the counters that have come out with their numbers. And Chola Investment also, that one is flashing bottom of your screen. 0.5% uptick or so coming in on that particular counter. Gurmeet, I wanted to get your view actually on the NBFC space. Too much has been spoken about banks of late, given the fact that they were in a very reasonable valuation zone and everyone was actually parking their money in the banks and believe that that one or that sector will lead the growth going ahead. But what about the NBFCs? Do you think that they merit to
The quality ones have actually already outperformed. Look at how Bajaj Finance has done after virtually not doing anything for 3 years. And the guidance also in this book, large book now is upwards of 30%. The leadership transition issue is behind. That was one overhang on the stock. We just seen Chola numbers came in while we are the numbers are flashing. Optically, if you see the NIs are again up 30%. So well-run NBFCs where cost of funds, especially the AAA rated ones, there's an immediate impact on cost of funds. They do not have CASA per se. So today a AAA 1-year rate is around, let's say, 7%. That's like 50, 60 bips lower than what it was. So incrementally now with cost of funds coming off and credit quality being under control and better managed ones having very little exposure to microfinance or the vulnerable section of unsecured loan would probably tend to outperform some of the other ones which have a higher share of unsecured loan and microfinance. Also, I think housing finance also as a group you should see relative outperformance again. So I'm pretty constructive, but again, here you have to be a little more selective and not just put everything under one basket.
What's the take on insurance? And I was just looking at SBI Life's numbers. The margins look healthy at about 27.8%. They've guided for FY26 in the range of about 27 to 28%. Yeah, the commentary on regulation is a little bit hazy, but other than that, the entire segment, because it's really not been able to take off as one would have anticipated, given the kind of opportunity that it has, as a structural theme.
So, I think numbers are better. Also, not only in terms of the APE growth, which is annualized premium equivalent, or VNB, which is value of new business premium. Also, in terms of ratios, persistency ratio, the overall mix. SBI had a very high reliance on non-PP products versus PP. So I think the mix is also coming back. I think which has a long-term impact on margins too. And insurance, Aisha, as a sector has been underperforming and under-owned within financials. So maybe because after, if you look at HDFC Life, the 3 year back, the high was I think 750 or 770 or something. You're still at roughly around 700 levels. Same is the case with ICICI. SBI relatively has been slightly lower in terms of valuation. So bit of valuation comfort, bit of underperformance over last 2 3 years, and the fact that it is under-owned could drive some near-term interest. But I'm saying structurally speaking, this will give you market returns in line with what, let's say, a bank nifty or a financial index gives. I think to probably do a little better, you need to be probably anchored with well-run NBFCs and some good private banks which are outperforming the market. So if you look at ICICI Bank, for example, I mean, 18% kind of a growth sustained in this environment with pristine asset quality and unit profitability metrics and core PPOP looks clearly stand out. So I think you got to be where there is relative outperformance happening, not only in terms of credit and deposit growth, but also in terms of asset quality.
Arpit, let me come to you actually, and let me switch gears and move to actually chemical space. I wanted to understand what's your view on that, on the charts. How are these chemical names looking to you?
If you see overall, the chemical space has been quite outperforming in the last couple of months, and particularly if we talk about stocks such as SRF or UPL. So, in spite when we have seen good turmoil in the market, but these sectors were holding well. And within that, if we look at the chart structure of SRF, so technically a classical range breakout on the monthly scale after almost 3 years trading at life high territory in spite of market weakness, trading comfortably above 2800, 2900 levels. So I think SRF looks technically very strong on this in this space. Along with that, UPL and Chambal, all these three stocks are looking very strong on the chart wise. So today we have seen some cooler from the higher levels, but going forward, as soon as we see some recovery in the market, definitely this space is likely to outperform. And from here on also, the stocks can be good buying opportunity at lower levels because the bigger trend of the stock is positive. So SRF, UPL, and Chambal, all three would be a preferred picks within this space.
Okay, that's the take coming in on the entire chemicals pack and how that has been faring and looking. Tech Mahindra, they've reiterated their FY27 goals of revenue growth above peer average, EBIT margin of 15%, ROCE of 30%, and of course distribution of 80%, 85% actually of FCF to shareholders, which is why the brokerages have liked this, this particular counter and how the earnings have panned out. Just looking at the rest of the market, and I want to check in on what Reliance is up to ahead of its numbers. Absolutely flat, although it's had a bit of a tumultuous ride, much like the markets today. Started off in the green, dipped from there, languished for a little bit, and now again on its way to recovery. Gurmeet, are you anticipating any magic from RIL? Has been a significant underperformer as opposed to the rest of the market even in the last 1 month, and we're not really expecting any big performance from the O2C segment at least. But do you think Jio can really pull the magic up?
Well, I think Jio will probably have a bit of a better performance vis-a-vis an O2C as well as retail. Retail likely to be a little more subdued, O2C more flat to subdued. And there'll be some benefit Reliance has because of better mix in terms of 4G and 5G. And the fact that the ARPU could see a 3-4 rupees incremental movement, maybe from 203 to 2067, if my memory serves me right. But I think the bigger play, Aisha, for a bigger re-rating is, whenever Reliance does capex, which is what it did from 2013 to 18, it sees underperforming because the street gets worried about debt and lack of cash flows. And similarly, last 2 3 years they have been undertaking capex in new energy, and anyways, telecom is always ongoing. I think market would want to see some monetization, some clarity on the Geo IPO, some monetization even on the energy business, which took off and got shelved with Aramco deal not seeing the light of the day. I think that's what would be to me a bigger trigger. So if you see relative last 1 year, Bharti has been what 40% up, if I'm not wrong. Reliance has been pretty flattish, although right. So I think Geo can probably cushion off some softness in other businesses. But the big trigger to me is monetization and street wanting to see that the incremental capex is coming off and free cash flows are going up.
All right, so that's the take coming on Reliance Industries. Let me quickly take the BTST ideas from our experts. Jatin, you go first. Any BTST ideas?
its support zone. So Chola Finance becomes a buy or a buy BTST trade for Monday. I think that there is a room for the stock to move it up from current levels. So Chola Finance is a buy. On the upside, I am expecting levels of 16.25. One should keep a stop loss of 1520 for this recommendation.
Right. What about you, Arpit? Any BTST ideas?
So if you see overall the cement pack has been outperforming, and if you look at the chart wise also Ultratech is quite strong. So technically on the monthly scale it has given a range breakout after almost 9 months. Daily scale it is holding well, good recovery seen from intraday lows. So I think definitely from here on we can see good live highs in coming couple of sessions. So Ultratech would be a preferred pick within the cement pack. One can go long at current level with keeping stop loss of 11,800 for an upside towards 12,600 levels.
Okay, that's the take coming in on some of those BTST ideas. But Gurmeet, other than that, where do you think the month of May is going to head amidst all that uncertainty still on tariffs at a global level? For our markets, other than earnings, what do you think could act as a trigger?
I think as RBI's change and pivot, not only in terms of just rate cut or stance, more in terms of liquidity communication, that liquidity has to be around 1% surplus of the NDTL. The overall guidance, how they want to support growth, I think is spelled out clearly that the regulator now is pro growth versus a more balanced approach last year. So that I think is well. I think also they were micromanaging some stress assets, whether it was unsecured PL, whether it was gold loan. They took actions on IPO financing. So I think somewhere they want to now, not strangulate or over-regulate. So I think that to me is one trigger because of which rate centers and financials will continue to do well. Also, I think you probably will see a bit of a movement. So in US they are calling it Wall Street to Main Street. In India also, for example, you will see. So I think you have to focus on where government is wanting more money, more investments to come in. For example, 22, 23, who would have thought defense, railways, and PSUs will make money, right? They were so under-owned. I think that is what's going to the street needs to focus on. Focus where the deals are happening in terms of bilateral deals. So next 2, 3 months, you need to probably navigate well and be more on a preservation mode. Do not be very aggressive in the market. Every year you can't make 20%, 25%, and see where are the low-hanging fruits in terms of valuations, what is under-owned. So I think a good mix today, even, and I've been saying this now for a while, the bond portfolio still can give you double-digit return. When we spoke last time on this, I told you the 10-year bonds were around 7% 6 months back. So if you bought even a government bond, your last 1 year return is double digit. I think with RBI cutting rate, even that is conducive. So I think having a very balanced asset allocation right now, a bit of bond, bit of gold, equity, be little more large capish or industry leaders, would help. And once these things is out of the way, that's when you focus on where the deals and treaties are happening, and that's when you get into export opportunities. So I think resetting not only from the market point of view, your expectation point of view is extremely important.
Right. Gurmeet, what's your take actually coming in on some of the realty names? Are you looking at that particular space at this point in time, given the fact that a lot of call is for domestic oriented sectors and realty is one of them?
I believe that probably a large part of the return is behind us. Whatever we have seen is the launches have been more on, premium or mid-premium segment. The lower end hasn't seen much, and probably we are at the mid cycle in a lot of geographies as far as real estate prices are concerned. And there is a bit of a rub off when other asset classes like equity don't do well. There's a bit of a rub off, especially if you're only into premium projects. You can be geography wise selective on it. So, for example, DLF might come up with a REIT and monetize its retail assets a little more here in North. I think some of the South-based players have been doing a little better with its Brigade, etc. But I think the bigger thing would be more consumer discretionary spending, right? And I think that is where on the consumption side you should be focused on, especially where the next generation, the Gen Z spends, which is your travel play, your tourism play, your digital consumption plays. So you have to relook at the consumption basket again and see where it is going. So to me, it was more white goods, electronics, travel, tourism, as far as consumer discretionary is concerned, versus the traditional FMCG or real estate plays.
Interesting that you say that. So, Gurmeet, even at the current valuations within the entire consumption and, you know, the new generation consumption, if I could call it that, where are you finding opportunities?
So, we bought some hotel stocks. We've been very early into Indian hotels and Lemon Tree. Uh, we have Indigo, Interglobe in the portfolio now with 65% market share. There could be some short-term disruption right now because of airspace issues, but this is more momentary. Uh, we have some plays like Zomato in the portfolio, although there's been last 2 quarters have been a little soft. We are evaluating some new plays, and to me, the capital market plays, something like a CDSL or CAMS or some of the asset management companies are also digital consumption, which is the way new generation does. So you have to make a portfolio. And then we have white goods, some of the plays, including Trent. Then we have Voltas and Blue Star in the portfolio. So we are trying to basically have a diversified consumption basket, more on discretionary and less on FMCG staples or real estate heavy names, which are the traditional traditional consumption baskets to be in.
All right, so that's the take coming in on the consumption space. But let's take a look at Sriram Finance. They've just come out with their numbers. The stock has actually taken a nosedive, 7% downtick coming in for Sriram Finance. We'll try and dwell further as exactly what's gone wrong in the numbers. No doubt, if you look at the NIMs on a quarter-on-quarter basis, there's an easing of the NIMs. It's coming at around 8.25% as against 8.48% on a quarter-on-quarter basis. The gross NPA, net NPA, they've bettered actually on a quarter-on-quarter basis. The board has said that they've approved the proposal to offer payment services through mobile wallets and prepaid cards. The AUM has seen a growth of about 17%. The PAT and NII, all of them have actually seen an uptick. And if you compare it to the ET Now poll, the numbers are exactly in line with estimates, Aisha, but not sure what exactly is marring the performance. 7% downtick.
Yeah, considering the NPA, ease off has been quite significant for Sriram Finance. But this is one of those very, leader portfolio stocks, and I don't think it's fallen too much as well in the market fall, or even if it's fallen, it's recovered as well, as much with as much swiftness in the last 1 month. If we can just bring up how the stock price has performed, we will get more details, because what I see, the net NPAs are flat on a sequential basis. The gross NPAs have seen quite a significant improvement as well, and the NIMs, it's a slight bit of dip that they've seen, but at 8.25%, I don't think those numbers look all that bad on a sequential basis. But the stock definitely is tanking quite a fair bit. About 7% is the knockoff that it's currently looking at. Where else is strength? It's largely within the entire mid-cap technology space, led by Emphasis, Persistent, Coforge. They're the ones which are holding out. SBI Life continues to be in the dominant position after its numbers. And other than that, you're not really seeing any material movers from within the Nifty, at least. Yeah, there is TechM, there is a TCS Infosys, but nothing meaningful of a move is what you're seeing from these counters. Unilever flat, Reliance a little soft as it steps into its numbers, and flat for ICICI Bank as we speak right now. Gurmeet, any opportunities you think within staples that one could look at?
The food part, Aisha, can do well. So Tata Consumer, for example, has done relatively better compared to the normal FMCG names. See, if you are at 50, 60 times even post-correction, and you are giving 2-3% volume growth, I don't think this is a market for that. So you got to be a little careful there. So I think the food part, especially Tata Consumer, I also think ITC to a certain extent has been relative underperformer, but that's what ITC does, doesn't do anything and do that. And at some stage, maybe the QSR space could look good, but that's been an underperformer for a while. But with input inflation coming off, a lot of them like Westlife, Jubilant now reaching that critical part in terms of the number of stores, focusing more on store profitability. So I think that could be an interesting place. See, Haldiram got valued at 85,000 crores. The entire QSR space, all listed space, is less than 60,000 crores. And with the kind of changing food habits we have, there could be some winners here. But that could be more long run, nothing from an immediate perspective.
All right, then we leave it there. Thank you so much, Gurmeet, as well as Jatin and Arpit, for joining us on the show to give us a take on the markets, given the fact it's the last trading day of the week.
If you like this video, then like, share and subscribe to ET Now.